Alright. So when the examiner is going to go for cash flow statement, or when he goes for cash flow statements, then I do two things. Alright, the paper is yours in the exam hall. So the first thing you do is put on your skeleton like this and leave as much space as possible. The paper is yours, you paid for it. If it is exhausted, you take more. So you prepare a pro forma, leave a reasonable space. I don't know, maybe the things are right here, they don't go there, whatever. I don't know, but I just leave a space. I don't know, just leave a space. So we put our schedule down. So Bishop, group cash flow statement as at 31st year 2. And as always, we start from there. Then this figure is always going to be there, so I bring it out because I don't have to think much. So we go back to our question and realize that that is a figure I circled because that is profit before tax and finance cost. Profit before tax and finance cost. So that becomes my starting point. Alright, so now that I put the skeleton down, now how did I put the skeleton down? I put the skeleton down because of the requirements of the question. The examiner said I should prepare a cash flow statement. That is why I put the skeleton down. So let's go back to the question and let's try to understand what really the examiner is talking about. 1. You are provided with the information set out below relating to a group of companies. Consolidated income statement for Bishop Group for the year ended 31st December year 2 has been given to us. Now, from the income statement there are two things that we need to look out for in much detail. So, first thing is about the finance cost. He said we should go to note 2. Then the income tax, he said we should go to note 3. Then another thing we have to be careful of when we are in the income statement is to look out for this particular information here. That is equity shareholders and then non-controlling interest. Why are we supposed to do that? We are supposed to do that perhaps if we want to calculate dividend paid to shareholders and calculate dividend paid to what? NCI. But as you can see on the next page, the examiner has done these two things for us, so we are not going to do it again. So if you check this schedule here, we are told that share capital, share premium, blah, 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 NCI. So there is an issue of share here. So this total figure, issue of share, I bring it here without thinking. Issue of shares. That is a tick I'm taking, and that is a half mark. So I pick it up. 3824. Are you seeing how simple this thing is? So you pick it up straight. Next one, it says profit for the year. We are not interested in that. We'll come back to that. Dividends. You saw that we pay dividend from retained earnings, and there is to shareholders how much? 895, and then to NCI 295. So NCI dividend. Does it come here? Yeah, it comes. Dividend to shareholders. Must I think? No, because I just pick it up, 600, subtraction. Then the one we pay to NCI. Must I think? No, how much is it? 295. I bring it here. Menye BBIO says I menya 1.5 mark. I've not done anything. 1.5 mark. Let's go. Exchange gain. That is a non-cash item. Non-cash. So we will come back to that. Now, it says the exchange gain is exchange gain on translation of the subsidiary. So when we had a foreign subsidiary. So when we're bringing the foreign subsidiary's record to the parent currency, that was what? The gain we had. 700. Is that a cash item? No, that is a non-cash item. Consolidated financial position is as follows. Now, tangible assets, I can see an increase. Investment, I can see an increase of 300. So if investment has an increase of 300, from the question there was nothing else about investment. So that increase in 300, I bring in under investment activities and I'll call it acquisitions of investment.
That is not related to the partner's income.
Why did you think that way?
Well, I think it's an investment, like let's say you invested in an associate or something.
Right?
So we receive income income respectively.
Yeah, we've received an income of 90. But do we add the income we receive on investment to the investment? This is not investment in associates. That's where you were thinking it.
No, it's big investment.
It's just investment. Like you have put a fixed deposit in the bank. Do you add your interest receivable to the investment to increase your value at the end of the year?
No, in order to know the cash flow. Because if I invest and my value is there, when they pay me, when interest accrue, I'll add it to it. So that will be the value. Then maybe if they pay me, that will be the cash. Just like how we do the investment in associate, because there's an investment there. When the associate pay us, when they don't pay at the end of profit, we add it to our investment. Now the closing balance of that investment minus the profit and everything, that will give us what they paid to us.
Good question. Do you know why I know that of the birds, come back to the income statement. Do you know why I know that of the birds, this $90 we received it? Do you know why I know we received it? Because there is nothing in the balance sheet under current assets like investment income receivable. Are you getting the picture? This is how you understand what you are doing. If there was an investment income receivable, then I would now conclude that this exchange here actually includes that interest that we've not yet received. But since it is not part of current asset, that means that 90, we received it. And that one, we have to add it. So our income here.
So this is a normal investment.
This is a normal investment. It's not investment in associates. So, yes, madam. You didn't get it. Right. His question was that, why am I writing this investment 300 here as an acquisition? And that he was thinking it should have linked with the finance. And I'm saying that, yes, there is a finance of 90 here. Okay, there is 90 here. But the reason why I know that money, we receive that money, is that when I come to the non-current assets here, when I come to current assets here, can you see any investment income receivable there? No. That means that finance cost of 90 has been received already. In other words, that 90 does not include the closing balance of 3,000. Okay, so if that 90 was found here, then we would have opened investment account and bring balance brought forward. How much? 2,700. Balance carried down in here 3,000. Then the finance cost 90 will be here. Then when I balance, the balancing figure will be what? The acquisition. I hope you're getting the picture. But this 90 has already been received because there is nothing like outstanding here. That's what I was saying. Do you understand that? Right. So the difference 300 becomes acquisition of the acquisition of the investment. So that, remember, this figure we picked here was profit before interest and tax. So you're not going to be adding and subtracting. Remember, you won't do addition and subtraction here. We will just add the finance cost relation to the investments here. The 90 is an addition, it's an inflow, so we add it to our operations. Next one. I am seeing current assets. You know the things I told you to do. We can see inventory. What is happening to inventory? What's happening to inventory? Increasing or reducing?
Increase.
Receivables.
Increase.
Okay. But these guys are increasing. And what are some of the reasons why they will increase? We discussed some of these things earlier. What did we say are some of the reasons why there will be this change in the current asset section? Even before we continue to read the question, the general change that would result into it. Yes?
We paid some of the cash out.
Okay.
Or we brought in
Some inventory. Okay. Or we acquire a subsidiary. And so the subsidiaries inventory or trade receivables were added. Then another thing that I didn't mention is about exchange. loss, foreign exchange loss or gain. Even I mentioned it, exchange loss or gain. That could also cause what? This change. So let's go to the next page. We can see lease obligation somewhere under finance lease. And you can see that in relation to the current and then non-current. Can you see that? Can you see the lease obligation under current liabilities and then under non-current liabilities? Yes. These are two components. So immediately I smell something like that. And if you come to note 2, which is where the examiner asked us to be, you could see that there is loan interest. Then you could see there is finance charge on financial lease. Then you could see exchange rate losses on long-term loans. Listen, again, exchange rate losses. If it is exchange rate losses, that is a non-cash item. The only thing that I'm going to be bringing here in relation to finance cost paid will be the loan interest and then the finance lease. These two figures. These two figures. Which one? I'm talking about the loan interest and then the finance charge on the lease. These are the only two things I'm going to bring into my cash flow. Why? Because the exchange rate losses is a non-cash item. Somebody brought the whole 330. I forgot the person. But somebody brought the whole 330. That 330 excludes the exchange. So you have to bring those two figures. What's the first one? What's the first one? 120, and the second one?
So are you not, why you not check the movement?
Movement in the
finance, the loan interest.
No, you know when it comes to interest, we just pick the current year. That one we don't check movement. We pick the current year.
Just even in the notes we check
Even in the
notes that they've done it like that.
Mm-hmm.
Even there we check the change, like why one is whether one is increasing or decreasing.
Let me get you. Come again.
I know when we are doing cash.
Yes.
The balance sheet, we do that. We check opening balance, closing balance. We even, when it comes to the capital, working capital, we check the change.
Movement. That's right. That's right.
I'm asking if they do the notes like that, do we check that the movement?
No, here you won't change the movement because
Just pick the current.
you pick the current. Let me clarify this. Assuming that you were having finance costs in the balance sheet, do you see finance costs in the balance sheet, please? Do you see finance costs in the balance sheet?
Yes.
Where is it?
Usually under finance lease.
No, that is under leasing. But do you see like finance costs in the balance sheet? No.
Interest payable.
But do you see interest payable?
No, I'm asking like interest payable.
Interest payable. Do we see that there? No. So we don't do the movement. You know that the interest that's supposed to come here is actually the interest for the current year. Okay? For the current year. So we wouldn't look at the movement. Yeah?
This one, why don't we, after we did the PBIC, add all these things? Because definitely we will adjust them. So we'll add them back. We'll add all of them. When we add them, then when we are going, if there's anything that we need to subtract, we subtract. If we have to add it, we add it.
Derek, why would you commit such a crime? By adding all of these things in the example.
I'm asking is that,
Yes.
you see, the finance cost we are doing under the lease.
Yeah.
If
No, this is not finance cost under lease. Oh. Be careful. This is finance cost relating to our investments, 90, right?
Like the gain, interest.
The interest that we received, okay, the 90 from the income statement, right? Then the finance cost, the second finance cost we are dealing with here is the finance cost provided to us here.
Yes.
Because remember what was charged in the income statement. In the income statement, the finance cost charged there was how much? 350. So what was the component of that 350? The component of that 350 was what the examiner has clarified for us here. Are you getting the picture? As 120 for loan, 205 for finance lease, and 25 for what? Exchange rate.
Yes, and I'm asking that, you see, for instance, if we want to adjust the loan interest, we are going to take the loans, right?
Yes.
We take the opening balance of the loan.
Can't make it simple for us?
We add the interest, we add the loan interest. You look at the closing balance, the difference is the repayment. Is it correct?
Come again.
For instance, the loan interest.
Yeah.
We want to work on it.
Yeah.
The cash flow element, we take the opening balance of the loan, which is 800. Is it correct?
We take the opening cash of the loan. Okay, yeah, which is 800. Yeah.
Then we add the interest of 120. Is it correct?
Okay, so what you're saying here is that 800.
Yes.
So you prepare loan account,
Yes.
opening balance of 800.
800.
Then the interest charge
120.
of 120.
And the closing balance is 1,200.
1,200.
So is the difference not the cash flow?
Never. If it is the cash flow in relation to what?
So what's the difference?
The repayment.
How can that be a repayment when the figure here is bigger than the figure there? Is it a repayment or issue of loan?
Or maybe we've taken in additional loan or something. Either way around.
Remember, the notes to the account are treated twice from your FR class. One in the income statement, two in the balance sheet. So note that everything in the balance sheet already has these notes there. So why would you go ahead and go and add it to it? I don't know if they understand what I'm saying. I should come again. Okay, so I'm coming.
Go back and start.
I should go. Okay, now listen to what I'm saying. Notes to the accounts are treated twice. One in the income statement, two in the balance sheet. So these notes here have already been reflected in the balance sheet. So if you're now preparing a loan account and you pick the opening balance and you go and add the 120, this 120 is already in the 1,000 to the closing balance. Because when you add, you are confusing yourself more.
I don't know how we've been doing it.
Listen, this is what we used to do. We pick, because there is loan different at start and at the end, isn't it? Then there is interest in the income statement. In that case, you do this workings. But this is notes.
The interest will be interest on loan.
But
Interest on
it's
what?
the same dynamics in the notes, but they
the
broke
one
it
in the
down.
income statement. That we'll use in preparing the accounts like that.
I don't get that was in.
You said the
800.
loan brought forward.
Yeah.
Then the loan, this one. You said when do we prepare accounts for loan?
For instance, if let's say that where is our loan? Where is our loan? Where is the loan balance sheet? So where's the loan? Yeah. So we see the loan 800 at year start, isn't it? And then how do we call it? 1,002 at year end. Then we see also in the income statement that the examiner made a reference that finance cost is 350. So when we go to the finance cost, we are seeing that there is a breakdown here. That the loan interest is what? 120. So what is Derek saying? Derek is saying that, all right, we pick the balance opening and we bring the interest. So when we strike it out, what will be the balancing figure? So that, how much? 280. So that 280 will be referred to. No, this is 1, 2 riders. 1, 2 riders. So you mean a balancing figure?
Won't it come here? To come to this side, I'm not saying it's wrong.
What will come to this side?
Come to the credit side there.
Okay, so this side, right?
280.
280. So what is this 280?
Loan that
Loan that.
we've taken. Issue of money. Because insurance is still the credit side. So if that's how we are doing it, then this is more loan that we are taking. If you
So-
don't see it, then we pay.
So the question is, what interest have we paid this year in relation to loan?
Okay,
Yes.
I was following question has confused me. Their question. So, in assuming that the question was that you see this one, you are saying that there is no need that we prepare a loan account. Okay. I get the fact that the opening balance is 800 and the closing balance is 1,000. So at what point in time do we prepare the schedule? Because the 120 you are saying is in the P&L.
Now, I'm not saying that we're not going to prepare loan accounts. We're going to prepare loan accounts. But what I want you to understand is that in the preparation of the loan account, this particular 120 figure, why are you bringing it there? Why are you bringing it there?
This is the okay.
So under what?
Let's say I don't get it.
Right?
Come, let me ask the question again.
Let me now give you another reference to it. Go to liability. Do you see any loan interest outstanding?
That is what I was coming to say. So this is the loan itself.
Paid. Loan interest paid. So it goes back to the first question you asked me. You come to the balance sheet. So if it was something
Like
outstanding,
yeah.
then you would have added. But since there is nothing outstanding.
So if this 120 was in the current liability, then we could have added.
Yes, we would have added.
Okay.
But since it's not in current liability, that means this 120 is the actual loan interest we paid during the
That's the
period.
cash
you paid
I'm
already.
confused why we are bringing the interest here.
No,
And
no,
we are
we are
preparing
not
the
going
loan
to
account.
Yes,
Exactly.
we could have bring it if it was in the balance sheet as part of current liabilities. The reason is that
If it's a
yes,
liability.
but here it is not there, so we don't have to what? Bring it.
So now if it was in Canada, it means we owe.
Yeah, we owe, so it will increase our liability, so that the balancing figure will tell us whether we have repaid some loans or taken more loans.
So now it means we paid.
We've paid because it's not in liability.
Oh, yes.
And you're magical.
I mean, my
If
problem
it
is
were,
with
if
that.
it were a current liability, it means that you add it to the
Opening balance because it will increase.
to know how much you owe. As
Yeah,
a
that's
loan.
right. That's a
Yes.
loan.
That makes sense.
That makes sense. Is it good?
Sure. Yes, it's good. Sure, my problem. What's the exchange rate losses on long-term loans? Why are we ignoring it? Is that what-
We are not ignoring it because when we come to where you guys want me to go,
Please, I break you up where on the finance charts, those things. That's where.
yes. And so the natural two is barging in inside. So I was saying that when it comes to finance costs to be subtracted in our cash flow, what do we bring? The loan interest paid and then the finance charge also what? Paid, 205. Now, how do we also know that these are the two things we have to bring there? Go back to Ebaze, balance sheet again. Let me do another reference there. Lease obligation, what do you see there?
740.
740 for more than 1 year, and then
Yes.
110 for what?
Current.
Current year,
Yes.
isn't it? So if you look at this scenario there, have we paid this finance cost in relation to the lease or we've not paid?
We don't pay.
Sorry?
We haven't paid.
Why?
Because there's a
Can't you see less than 1 year is less than that figure there?
That was coming in.
Which one?
Come on, look at me here, look at me
Sure,
here.
looking.
The obligation under finance lease and the current liabilities, the
Yeah.
110. Can you see that?
Yeah.
And then the obligation under non-current liability, obligation 740. And I'm asking, this 205, have we paid it or we've not paid?
We have paid.
Why?
Because if we have not paid it, we would have seen it under current.
If we've not paid it, we would have seen it under current liability. But current liability, there is still a lease of 110 there.
Yes, but
It's right, that one
but
there,
205 is bigger than 1.
It's a charge. We paid more than that.
You've paid more than that. So what did you actually pay? That means the 205 is what you have actually paid. Anything a major will say.
Which I didn't get to. What's happening?
Maybe will break fast.
The 110. This I'm coming with the 110.
Yes.
Yes, right. The 110. It's not current like finance cost, interest payable. The 110.
Yeah, about the lease obligation.
Yes.
So this is what we do. Look at it. Look at
The
it.
current.
So you push me there, let me do it. So lease obligations. Make sure you follow. It's not going to be like direct in the exam hall. Don't take it direct because you are now chartered accountants, for goodness sake. So current liabilities, let's go for it. So balance brought forward less than 1 year. Can I have the opening balance 50?
Yes.
Another one, more than 1 year. And because I'm preparing lease obligation accounts, why do you want me to separate it?
It's just like we having loan interest and loan. We shouldn't put them together. Is that not what it's here?
This is about lease. And lease obligation at the end of the year will have to be separated into current and non-current.
Is the lease not the capital? You know, the lease can have the principal and the interest payment.
So I'm thinking of the current and non-current.
Non-current and
So
non-current.
all they are looking at here is they are all interest.
No. They are all in relation to the lease, which includes both our installments and our interest, and then lease has two components:
Yes, that's
installments
what I'm saying.
and interest.
So the asset itself, the payment, like the capital and the interest portion. So it's just like having a loan itself and the interest portion. So is that not what is here?
Yeah, that is what is here.
So what is in the P&L is the interest portion that has been charged or maybe paid.
Yes.
So we should rather agree to the current one.
Not the non-current. Why? Otherwise, how would you see lease obligation, extra finance lease that you have taken? Because go to the final note, because he told us that.
That's what I'm saying, that then we have to do separate. Just like loan interest and the principal, the loan itself. Just like we said.
No, when I told you, when I told you about the loan, didn't I tell you we'll be adding the interest to it if it has not been paid? Is that not what we said, Elvis? That if the interest is in the current liabilities, what do? We add it to it.
Yes, so we do a different computation for interest. That is taking into account the interest charge in the P&L and the interest payable. Before we come to the loan itself.
Where are we here? We are in the lease obligation account, assets that we are leasing. So the loan account, and Casano, don't you bring the loan and the interest there?
So I'll do a loan account and an interest account.
So in the loan account, what do you bring? Only the loan.
Yeah, the loan, the movement in the loan.
So no interest effect. So if the interest is outstanding, you won't add
So
it.
I'll do the interest portion separately. So the repayment of the loan is the repayment of the interest.
Mm-hmm.
It's wrong.
It's wrong. That means you didn't get what we did.
So what if the interest, so other interest, you have ever interest, then how?
No, the loan, he said the loan interest. You see,
So the loan.
Under cash flow statement, and you want to find out the additional acquisition on the lease, or you want to find out the lease cash that has been paid in relation to the lease. This is interest. You see the 1 whatever is there is the interest that we paid on the lease. But the question is, how much money did we actually pay in relation to installments and whatsoever?
So I think we have to.
So the lease obligation account, putting together the current and the non-current, will give us the cash that has been paid. Now, relax. Let's look at the account, then the picture will be clearer. More than 1 year, what do we have? More than 1 year, non-current. You sure about that? 250. Okay, so closing. Balance carry forward less than 1 year. What do we have?
Less than 1 year is 110.
110. Balance carry forward more than 1 year. 750. Then during the year, what? 740. Then we were told that during the year, note 5, during the year the company did what? Additional under what? Finance lease. So we bring in here additional of 700.
So finance lease is accounted for as an asset owned by the company itself.
But a liability. Because you know it's a
Bring
liability.
it in, bring it in, PPE.
Yes. So this 700 will go to PPE as an acquisition because it will increase our asset base. But when it comes to the lease account, then it's a liability. So the only asset component is this particular thing. So Derek, look at it. Now, if I'm in the lease obligation account, I'll bring the charge for the year. So charge in income statement. What was the charge in income statement for the lease obligation, the finance cost? 205. What's the double entry? We debit income statement, credit what? Lease obligation, 205. Now, when you balance this account, the balancing figure will be the cash paid for this.
I think that's what I did. I omitted that.
You omitted what?
Additional.
And so you omit.
But what I'm trying to do is it's the same understanding that I used to do the loan. But it's like what I did in the loan was wrong.
Yes, because in the loan, the reason why the loan was wrong is that where was the loan? And that's why you don't get it. Why?
Because what we did, I did the same thing without understanding. I used the same thing to do the loan. But when we did the loan first, I said that approach is wrong. So I thought then we'll come and apply the same thing when we are doing the lease.
Oh, okay. Okay. So now I got
I'm
it.
sitting on the fence.
You know, I'll say I'm sitting on the fence. You don't have to sit on any fence in relation to the fact that what is here, less than 1 year, more than 1 year, actually means that this closing balance here, okay, is actually divided into two. Both the current and then the non-current. You see, when it comes to lease obligation, lease is different from loan. Why is lease different from loan? Because lease has a current aspect and a non-current aspect. Loan, there is only a current aspect when there is loan interest payable in the current liability. That is why I said you can't use that approach there, because under current liability we don't have loan interest payable. But under lease obligation, we have lease obligation payable, which is the less than one. So here it's going to work. But the loan notes, it cannot work. Why? Because we don't have loan notes payable in the balance sheet. Do you get the difference?
Yes.
Pajamon balancing money. Which side is bigger? Number one answer. Let me show you.
The credit is 1205.
1205. 1205.
That's it. 355.
355. And that is the cash what? Paid. So this is the cash paid to lease obligation. This is a cash paid to lease obligation. So if it is the cash paid to lease obligation, is it an acquisition or a disposal? Cash paid means cash paid. We paid for lease. So where does it go? Right? So lease obligation.
So what about the finance cost?
Yeah, we're going to bring that two figures I asked you we're going to bring. Where is it? These two things, add it together. 120. The loan plus the finance charge with the interest payments. Are you getting the picture? You said? Write into bracket what?
120
plus 205. So lease obligation working is 1.
So Nhyira, let me take you back again.
Okay.
So can you summarize why we prepare the lease account this way?
Okay. The reason why we prepare the lease account this way is because lease has both current and non-current components. And as such, it means the charge for the year is already included in the closing balance. That is why we have to what? Prepare it this way.
Is it because you see when you
prepare from IAS 17, the normal 17. IAS 17.
Okay, sorry, I think so.
When you prepare the normal, is it because when we do, for example, we do the
When the amount of 700 now.
If you will read this as 700 no. Alright, Elvis, are you okay now? Are you okay with that idea?
So the difference is there.
Interest cost, this will go.
The loan is the only one that has a different treatment.
Yeah, the loan in this case has different treatment because Sankayawo current liability loan interest and can also be cost. But you need that treatment, and that means loan is there, you will treat you on different. Loan is our financing, isn't it? So we will treat that one different. You treat that one different. How do you treat it? Because you just look at the opening balance. Maybe let me do that working here, and you write it, then I clean it, okay? Loan account. I don't have to do this back. So look at it. Loan is a liability, opening. What's the opening balance for the loan? Closing balance. But look at something. When you don't just do the difference and say, the 400 is no. Because the examiner has told us something here. He said exchange rate losses on a long-term loan. So what do? You're going to subtract that. Are you getting it? That means that figure was treated. So exchange rates.
Should you bring it there? Send it to that.
You bring it away? Because you have to subtract that from the closing balance. So it has to be on the credit side. Yes.
Initially, when they put their balance, they debited expense and credited.
Now, so listen. The treatment is that. You see, what is about? That's okay. You see, what is about exchange rate losses? What it means is that this figure here, okay, listen carefully. That means that this 1,002 figure here has the effects of that loss. And so what we do is that we're going to add it to the opening balance and subtract it from this figure and find out about what? The difference. That's why it has to be here and not here. Yes, it's included here and we are taking it out. That's why it has to be on the credit side. So exchange rate losses of 25 has to be here. So 1,200, 1,200. What's the difference?
Sure, is it because it's in the income statement? That's why it means it's been treated twice. That's the idea. Because he said once it's in the income statement, what you are treating. Exchange rate.
Yes.
So once it's already been treated. So when is it there that is not treated already?
No, once it is the statement is like that, that means it's there.
So when it's not there and then it's in there, it means it's not been treated well.
It can be so also. Because once the translation takes place, everything will reflect in the income statement. Sounds good.
Exchange rate loss.
So you see sometimes with the previous ones that we do, sometimes we have notes to the account.
117, and the balancing figure should be right here, right? 117 as tax paid. So I'm supposed to bring that after I do all the necessary gymnastics and something like that. You see, in the exam, you don't have to be robust, okay? You don't have to be too rigid. No. So even though I'm supposed to bring tax as the final item, I've done the calculation here. I could be just flexible and slot it there. Boom. Because it's supposed to be here, isn't it? As an outflow. So I don't have to do the adjustment that I have to do because as you saw, we are not doing much adjustments in this case here. Are you getting the idea? So I could bring it slash and slot it in on the face like that. But I'm waiting. Just remind me that I'm going to bring it. Then there is a final note there in the note 5. The examiner said,
So all the figures that you are not using any of them.
I don't understand.
I've have you gone to the
Yeah, I'm there.
I'm saying that the figures over there, you're not using any to prepare this because I realized that the opening balance and the closing balance, you took it from the balance sheet, and then the one page, you took it from the income statement. The PN, the charge for the year, you took it from the income statement.
Yeah.
And I'm saying that you didn't pick anything from here, or what you took from the income statement, the breakdown is what it says.
The examiner is explaining to you why there is 800 in the income statement. That's the breakdown of it. But we are not interested in any of those things there because we're just interested in what was charged for the year. Are you getting it? Because if you remember what I taught under IAS 12 income tax, I told you that the tax that is taken to the income statement is 3 components. 1, the current year tax, which is what you see there, deferred tax, and also under or over provision of what? Tax. And these 3 components, they are explaining to you that during the year, they all occurred. And nothing at 800 buy. So those breakdown there will not affect us. All we need is what's the total tax charge for the year.
Essentially, this thing, the cash flow, they can also bring some, maybe they bought some assets where you have to calculate the deferred tax charge and add it to all those things. Is it likely they can do something?
Oh, no. For charge for the year, there is charge for the year. You will take it straight out for the income statement. So you don't have to think.
What you are saying.
No, per what I'm saying, the examiner is just giving you a breakdown of what's happening, right?
Okay.
But it doesn't mean you would have to calculate the fair tax.
So, sorry.
Oh,
So when you do this adjustment and you don't transfer,
Now stay with me. The net book value of non-current asset disposed was 750,000 with a sale proceeds of what? 180. How do we do that treatment?
PP.
number 5.
Yes, please. How do we do that treatment? There are 2 things we need to do. What are the things we have to do?
You pick just like the lease. You pick the opening of the PP.
So we need to. So in the PPE account, what is supposed to be there? Relax. Before we go there, what's happening on this transaction? Can you see a profit or loss on the transaction?
Yes.
How do we treat the transaction? The proceeds from the disposal of Nankasabeba and there was investing activities.
Yes.
I claim that tick. So proceeds from disposal. I write it down straight. 800. It's a proceed. Then 810. Then I can smell some profit on it, isn't it? Of how much? What's the difference? 90, I guess. So, isn't it? So we less it. So profit from disposal. 810 minus 720, 90 less. Anything.
I think we were scared by the
Oh, yes,
the
for
length.
me,
You didn't read the question well.
Anything.
Yeah.
Shall I mean anything? Shall I? Anything. Okay, so let's go. Now that I have had all of these things, I think we've touched on a number of things.